All right, today we are diving into a massive showdown that could seriously define the global economy for years to come. We've got two incredibly powerful forces on a direct collision course. And, figuring out what's going on here is absolutely critical if you're trying to make any sense of these markets.
And wow, this one line from a recent institutional research note just nails it. It perfectly captures the conflict. On one side, you have this ghost of a really painful economic past, and on the other, you've got the incredible promise of a revolutionary technological future. It's basically a battle for control of the entire market story.
So that's the big question we're digging into today. And believe me, the answer is complicated, it's confusing, and it's so important for understanding where your money might actually be safe right now. So let's start by taking a look at the battlefield itself. To really get this clash, we need to survey the landscape. Recent economic data has created a really confusing and frankly dangerous situation for investors. The report warns it's a scenario that has markets trapped between two completely opposite forces.
This right here, this is the nightmare scenario for any central bank. On one hand, the economy is very clearly losing steam. But on the other hand, prices and costs are heating up. This contradiction basically paralyzes policymakers, right? It traps them between needing to support growth and needing to fight inflation. They can't do both at the same time.
So let's look a little closer at this ghost from the economic past. Its sudden reappearance can pretty much be traced back to one single shocking piece of data.
Negative 92,000. Just let that sink in for a second. That is the number of non-farm jobs that were lost last month. Wall Street was expecting a gain of 55,000. Instead, we got the absolute worst jobs report since the pandemic era. A huge shock to the system that screams the economy's engine is stalling out.
And this is where you can really see the two-headed monster in action. The stag side, the stagnation, shows all the signs of a slowing economy. Those awful job losses, falling retail sales, and a plunging number of people even looking for work. But at the exact same time, the inflation side, the inflation, shows prices are getting hotter, with wages growing way faster than expected and surging oil prices pushing costs up for everybody.
And there it is. That's the textbook definition of that ghost we've been talking about, stagflation. It is truly the worst of both worlds. The economy isn't growing, people are losing jobs, but your cost of living is still going up. It's just a painful economic trap, and the data suggests we're walking right into it.
And this is exactly why the Federal Reserve is in such an impossible position. What do? Do they cut interest rates to try and save jobs, which would risk sending inflation even higher? Or do they keep rates high to fight inflation, which could push us into an even deeper recession? As one Fed official put it, it's their worst-case scenario. They are completely and utterly trapped.
Okay, so this new stagflationary environment, it's a toxic mix for what was the market's biggest and most exciting story, the AI revolution. All of a sudden, that bright future doesn't look quite so certain.
And here's why this is so poisonous for AI stocks. The fear of stubborn inflation pushes up something called real interest rates. And here's the best way to think about it. AI and tech stocks are valued on the promise of huge profits way out in the future. Well, higher rates act like gravity on those future profits, pulling their value way down in today's money. It just crushes their current stock price. Now, this is what makes the current moment so dangerous for investors. Normally, in a downturn, when stocks fall, safe haven assets like government bonds are supposed to go up. They cushion the blow. But look at this. Not this time. Both stocks and bonds are falling together. The old playbook is broken, and there's literally nowhere to hide.
And on top of all the economic pressure, the AI sector is getting hit by its own storm of bad news. The big tech leaders are falling. You have new government regulations threatening chip exports. And at the same time, there's this growing fear that AI might actually destroy existing software businesses before it creates new ones. All of this is causing the market's fear index, the VIX, to spike like crazy.
So, if money is fleeing from the tech-driven future and from the supposedly safe world of bonds, where on earth is it going? Well, let's follow the capital. This table right here shows a massive repositioning is underway. Investors are basically selling the future, AI, tech, growth sectors, and they're buying the tangible, messy reality of the present. Money is flooding into energy stocks to profit from high oil prices, and into defense companies as a hedge against global conflict.
The report actually gives this shift a pretty cool name, the HALO trade. It stands for Heavy Assets, Low Obsolescence. So think oil rigs, weapon systems, physical infrastructure, stuff that costs a ton of money to build and, crucially, can't be easily disrupted or replaced by some new AI model.
This crisis is also revealing what big money considers a true safe haven. Traditional gold is doing exactly what it's supposed to do, holding its value as that classic hedge against inflation and uncertainty. Bitcoin, on the other hand, is completely failing the test. It's falling right alongside other risky tech assets, which just proves it's not the digital gold some people were hoping it would be.
So, the most important question of all is, how do you possibly navigate this incredibly treacherous environment? Well, the good news is, the research note doesn't just diagnose the problem. It actually lays out a pretty clear strategy for survival.
The report's main recommendation is to build a defensive bunker. Okay, so what does that mean? First, it means you have to accept that stagflation is the new reality. Then, you cut risk by selling stocks that are super sensitive to consumer spending or have a lot of debt. Next, you focus on those real assets we just talked about: energy, defense, and physical gold. And maybe most important of all, hold cash to stay liquid and safe.
But beyond this base case, the report issues a serious warning about a hidden danger, something lurking just beneath the surface. It's a potential black swan event that most of the market is completely ignoring.
That black swan? It's a potential meltdown in the private credit market. Now, this is a massive, less regulated corner of the financial system, sometimes called shadow banking. The big fear is that if a major fund in this space suddenly stops letting people withdraw their money, it could trigger a huge panic, causing a cascade of forced selling that spills over into the public stock market.
So what happens next? Well, it all comes down to one number: the next Consumer Price Index, or CPI report. This is going to be the moment of truth. If that number comes in hot, it's going to confirm that stagflation isn't just a theory, it's a reality. And that could be the trigger for a major de-risking event across the entire market.
And the report leaves us with this really powerful thought. In times like these, the promises of future tech and easy money can start to feel like a fantasy. What truly matters, what holds real power, are the tangible things that run our world, like energy and security. It's a pretty stark reminder of where this battle between the past and the future currently stands.